On this channel, I always make it a point to present both the positive and negative viewpoints about companies. I believe that having a balanced perspective is crucial so that investors can make well-informed decisions. It is easy to get caught up in excitement and hype, especially when it comes to fast-growing technology companies. However, by examining both the potential rewards and the risks, investors can approach their choices with greater caution and understanding. Today, I want to take a close look at a bearish viewpoint regarding Palantir Technologies, a company that has attracted massive attention due to its involvement in artificial intelligence. While I personally do not fully agree with every argument presented in this perspective, I believe it is essential for investors to consider the potential risks before deciding whether to invest in Palantir. Palantir Technologies has experienced what can only be described as a monumental surge in its stock price since the beginning of the year 2023. This increase has been driven largely by excitement surrounding artificial intelligence, a technology that has captured the imagination of investors, businesses, and consumers alike. However, some analysts caution that this explosive growth could be short-lived and driven more by fear of missing out than by sustainable business fundamentals. To put this into context, it is helpful to look back at history. More than 30 years ago, the birth of the internet revolutionized the world and sparked immense interest among investors. Since that time, there has always been a new technology trend or innovation that investors eagerly chase. Currently, artificial intelligence stands as the latest in a long line of these transformative trends. When most people think of artificial intelligence, the name NVIDIA usually comes to mind first. This is not surprising because NVIDIA's graphics processing units have become essential tools in modern data centers, powering everything from split-second decision-making systems to generative artificial intelligence applications and the training of massive language models used in chatbots and virtual assistants. NVIDIA's hardware plays a central role in making artificial intelligence solutions possible. However, there is a growing belief that NVIDIA's time as the undisputed leader in artificial intelligence might be coming to an end. Some now argue that Palantir Technologies has taken over that role. Since early 2023, Palantir stock has skyrocketed by nearly 2,000%, and its market capitalization has climbed to an astonishing $317 billion as of the market close on July 3rd. This remarkable growth has transformed Palantir from a company known mainly to technology-focused investors into one of the most prominent and influential technology firms in the world. The key to Palantir's success lies in the uniqueness and irreplaceability of its services. The company's Gotham platform provides federal governments with powerful data analysis and decision-making tools, especially for planning and executing military operations. At the same time, its Foundry platform is used by businesses to process vast amounts of data and streamline their operations. Because there is no direct one-for-one replacement for Palantir's artificial intelligence and cloud-based software as a service model, the company has been able to generate stable and predictable operating cash flow. This has given Palantir a competitive edge that is difficult to match. Moreover, Palantir has reached consistent profitability much earlier than most Wall Street analysts expected. Achieving recurring profits while expanding its market presence has strengthened investor confidence and given Palantir a powerful advantage. However, despite these successes, some analysts warn that Palantir's rapid rise in stock price may be more of a temporary phenomenon fueled by fear of missing out rather than a reflection of lasting fundamentals. This perspective argues that Palantir stock could fall by as much as 60% or even more. While this is certainly an unpopular opinion, especially given the tremendous gains Palantir has delivered to shareholders, it is worth examining the reasons behind this bearish outlook. One major concern is that investors have a long history of overestimating how quickly transformative technologies will be adopted and generate meaningful utility. Every major technology revolution over the past 3 decades, including the internet, has experienced a bubble-bursting event. In other words, initial enthusiasm and speculation often outpace the actual adoption and value creation that these technologies deliver. Right now, many businesses are still struggling to achieve positive returns on their artificial intelligence investments, and many have not yet fully optimized their artificial intelligence solutions. This suggests that artificial intelligence may follow the same pattern as previous technological breakthroughs, where widespread adoption takes longer than initially anticipated. Even though Palantir's long-term government contracts through Gotham and its business subscriptions through Foundry may help stabilize its revenue if an artificial intelligence bubble bursts, these factors alone may not be enough to protect Palantir's stock price from negative sentiment. Historically, when investor enthusiasm fades, even strong business fundamentals can be overshadowed by sharp market corrections. valuations. So far, Gotham has been Palantir's primary engine of profitability, with annual growth rates typically ranging from 25% to 35%. The company's close relationship with the United States government has undoubtedly been a key advantage, providing a reliable source of income and stability. However, the growth potential for Gotham is inherently limited. Because Gotham's services are focused on data collection and military planning, they are restricted to countries that are strong allies of the United States. This means that nations such as China, Russia, and several others are effectively off limits, reducing the total market Palantir can serve through Gotham. This limitation could cap Palantir's long-term growth more than many investors currently recognize. Additionally, the political landscape plays a crucial role in defense spending, which directly impacts Gotham's growth. A government led by the Republican Party has historically favored increased defense spending, which benefits Palantir. For example, former President Donald Trump has previously highlighted the importance of safeguarding domestic artificial intelligence developments. At the same time, Trump has also made promises to make the federal government more efficient and potentially reduce unnecessary spending. While past actions have shown support for defense contractors, there is no certainty that future administrations, including a possible Trump administration, will maintain the same level of spending. Furthermore, the outlook for defense budgets beyond the next 4 years remains highly uncertain. For a public company that has added over $300 billion in a market value in the past 30 months, one would expect exceptionally strong financial performance. While Palantir has indeed become profitable on a recurring basis, closer examination reveals that not all of this profitability comes from its core business operations. In the previous year, 40% of Palantir's pre-tax income, amounting to $489.2 million, was derived from interest earned on its cash reserves. Similarly, in the first 3 months of 2025, 23% of its pre-tax income also came from interest on cash. While there is nothing inherently wrong with earning interest on idle cash, this is not a sustainable or innovative source of income. It raises questions about the true strength of Palantir's underlying business operations, and how much of its profitability is driven by temporary financial conditions rather than lasting business performance. Another critical issue that has raised concerns among investors is Palantir's persistent use of stock-based compensation. While it is common for technology companies to use share-based rewards to retain and motivate employees, excessive reliance on this approach can lead to significant dilution of existing shareholders' ownership. In Palantir's case, the steady increase in share-based compensation has expanded the total number of outstanding shares, which reduces the value of each individual share. So far, this dilution has been masked by the excitement surrounding artificial intelligence and the resulting surge in Palantir's stock price. However, historical patterns suggest that this situation may not be sustainable in the long run. Investors should also pay close attention to the pattern of insider selling that has persisted since Palantir's initial public offering in September of 2020. While it is true that executives often sell shares to cover tax obligations, the scale of insider selling at Palantir is noteworthy. Since the initial public offering, more than $7.4 billion worth of Palantir stock has been sold by insiders. The only significant insider purchase in this time frame occurred when former Chief Accounting Officer Heather Planishek bought 10,000 shares in May of 2025. The lack of insider buying raises concerns about how confident Palantir's leadership truly is in the company's long-term valuation. Finally, the issue of valuation presents another significant risk for Palantir. Over the past 30 years, large-cap technology companies leading new trends have historically reached price-to-sales ratios in the range of 30 to 43 before experiencing stock price corrections. Well-known examples include Microsoft, Amazon, Cisco Systems, and Nvidia. In comparison, Palantir's stock recently reached a trailing 12-month price-to-sales ratio of over 107, which is approximately 3 times higher than those historical benchmarks. Even if Palantir achieves Wall Street's optimistic revenue projections, growing its sales by 263% to $10.42 billion by 2028, its valuation would still place it at a price-to-sales ratio of 30 by that time. This would only bring it down to the upper end of the historical range seen before previous market corrections. While Palantir Technologies has achieved remarkable growth and continues to lead in artificial intelligence and data analytics, it is important for investors to also consider the potential risks and challenges ahead. Overestimating the speed of artificial intelligence adoption, reliance on interest income, dilution from stock-based compensation, insider selling, and an unsustainably high valuation are all factors that could contribute to a significant correction in Palantir's stock price. As always, balanced research and careful decision-making are essential when investing in high-growth technology stocks. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.